A comfortable salary can feel like proof that your financial life is working. The bills are paid, the account refills every month, the car runs, the rent clears. There is enough for small pleasures, occasional travel, and the quiet relief of knowing that another paycheck is coming. But comfort can hide a dangerous question. If the salary stopped tomorrow, how much of your life would still belong to you? This is the wealth trap hidden inside a comfortable income. It does not look like poverty. It looks like stability. It does not arrive through one disastrous decision. It grows quietly through habits that seem reasonable. A larger home, a newer car, more subscriptions, more convenience, more obligations, and less room to breathe. Centuries ago, the merchants of Edo, Japan understood this danger long before modern salaries, credit cards, and retirement accounts existed. They knew that income was not the same as wealth, and they built their lives around that distinction. During the Edo period, Japan developed large commercial cities, active marketplaces, and powerful merchant families. Merchants handled rice, textiles, oil, paper, sake, tools, and countless everyday goods. Some became prosperous, yet their position remained socially fragile. Official status often favored samurai, farmers, and artisans above them. Wealth could be visible, but security was never guaranteed. A fire could destroy a district. A poor harvest could weaken demand. A political order could change trade. A customer could fail to pay. A family business could disappear within one generation. So successful merchant houses learned to distrust appearances. A full shop was not the same as a strong business. High sales were not the same as durable wealth. A respected name was not the same as financial resilience. What mattered was what remained after the season ended. This produced a simple but powerful principle. Live as though prosperity is temporary and build as though the family must endure. That principle stands in direct conflict with modern salary culture. Today, many people organize their lives around the assumption that income will continue. The monthly paycheck becomes the foundation beneath every decision. A promotion justifies a larger apartment. A raise justifies a better car. A bonus becomes a new recurring expense. Slowly, the salary stops serving the person. The person begins serving the salary. This is known today as lifestyle inflation. As income rises, spending rises with it. But the process is more psychological than mathematical. Human beings quickly adapt to improvement. Behavioral economists call this hedonic adaptation. What once felt luxurious soon feels normal. The first time someone pays for convenience, it feels special. After several months, it feels necessary. The mind moves the new expense from the category of pleasure into the category of expectation, and expectations are expensive. A comfortable salary can therefore create an invisible prison, not because the income is too small, but because the life built around it becomes too large. The Edo merchant saw wealth differently. The goal was not merely to earn more during good years. The goal was to reduce dependence on any single year. This required restraint. Merchant families often kept careful ledgers. They tracked what entered, what left, what was owed, what was stored, and what could be preserved. The ledger was more than an accounting tool. It was a mirror. It forced the household to confront reality before desire could rewrite it. Modern consumers often do the opposite. They judge affordability by a monthly payment. Can I handle this amount each month? Can I fit this into my salary? Can I finance it without feeling immediate pain? But this question ignores opportunity cost. Every recurring expense claims a portion of future labor. A monthly payment is not only money leaving an account, it is time already promised. The merchant asked a harder question. What will this decision prevent us from doing later? That is the heart of opportunity cost. Money spent in one direction cannot be used in another. A costly lifestyle may prevent investing. It may delay independence. It may weaken the ability to survive a crisis, support a family member, change careers, or act when opportunity appears. The true cost of comfort is often invisible because it arrives as lost flexibility. And flexibility is one of the purest forms of wealth. A person with modest expenses and strong reserves can refuse a bad job, survive a downturn, relocate, learn a new skill, or wait patiently during a falling market. A person with a high salary and high obligations may have fewer choices. The bank balance may be larger. The freedom may be smaller. This is why some high earners remain financially anxious. Their fear is not always irrational. They understand, even if only subconsciously, that the entire structure depends on continued income. One interruption could expose how little margin exists. Ancient Japanese discipline offers another way to think. Samurai training emphasized control before action. A swordsman who reacted emotionally could be manipulated. Fear, pride, anger, and impatience created openings. Money works the same way. Consumer culture studies your openings. It knows that fatigue increases impulsive spending. Status anxiety increases luxury purchases. Social comparison makes ordinary possessions feel inadequate. Easy credit separates the pleasure of buying from the pain of paying. The modern marketplace is not neutral. It is designed to convert emotion into transactions. A comfortable salary provides the fuel. Without discipline, every raise becomes an invitation to consume more identity. A person does not simply buy a product. He buys the feeling of progress, importance, belonging, or relief. But feelings fade. The expense remains. The Edo merchant's restraint was not joyless deprivation. It was strategic simplicity. By limiting unnecessary consumption, the household protected its ability to endure. By preserving capital, it created room for future trade. By teaching the next generation careful habits, it treated wealth as a responsibility rather than a performance. This is where generational wealth truly begins. Not with inheritance alone, but with inherited behavior. A family can pass down money and still lose it. Or it can pass down discipline, patience, record-keeping, modest living, and long-term thinking. These habits may appear ordinary, but over decades, they become powerful. Compound wealth depends on time, and time depends on survival. An investment cannot compound if it is constantly interrupted to rescue an oversized lifestyle. Savings cannot become capital if every raise is absorbed by consumption. Long-term plans cannot mature if short-term comfort always wins. This is why wealth preservation comes before wealth expansion. The first task is not to appear successful, it is to become difficult to destroy. In modern life, this begins with separating income from identity. Your salary is a tool, it is not proof of your worth, it is not a command to upgrade everything around you, it is not permanent. A raise should increase the distance between what you earn and what you require. That distance is margin. Margin can become an emergency reserve. It can become investments. It can become education, mobility, ownership, or simply the ability to make decisions without panic. But margin must be protected before the world finds a way to spend it for you. The purpose is not to fear comfort or reject every pleasure. It is to make comfort a choice rather than a dependency. A life built with margin can enjoy prosperity without being controlled by it because its foundations remain stronger than its appetites. One practical lesson from merchant thinking is to make prosperity invisible. When income rises, delay visible upgrades. Let savings, reserves, and investments grow first. Allow your financial foundation to improve before your lifestyle announces success. Another lesson is to examine fixed costs carefully. Variable pleasures can be reduced when needed. Fixed obligations are harder. Housing, car payments, debt, insurance, subscriptions, and other commitments can quietly determine how long you can survive without income. A third lesson is to measure wealth in time, not possessions. How many months could you live if your salary disappeared? How long could you wait before accepting a bad opportunity? How much of your future labor has already been promised to yesterday's purchases? These questions reveal more than salary alone. Finally, treat every raise as a decision point. It can expand your lifestyle, or it can expand your freedom. Most people do not consciously choose. They simply adapt. New income enters, new spending follows, and the feeling of financial progress never arrives. The trap remains comfortable enough to ignore, until the paycheck is interrupted. The merchants of Edo did not know modern index funds, retirement plans, or digital banking, but they understood a timeless law. What you keep, preserve, and patiently direct matters more than what briefly passes through your hands. Income can create comfort. Discipline creates durability. A salary can make life easier, but only margin can make life freer. The true danger is not earning too little. It is allowing a good income to build a life that cannot survive without it. So the next time your income rises, do not ask only what you can now afford. Ask what you can now protect. Ask what dependence you can remove. Ask how much uncertainty you can absorb, because wealth is not the size of the life your salary can maintain. It is the strength of the life that remains when the salary is no longer guaranteed.